Welcome to the Retail Tech Podcast. I'm your host, Darius Wasefi, and in this interview, I speak with Gil Penchina, an angel investor based in the San Francisco Bay Area. Gil's a very active angel investor with hundreds of investments and a few unicorn exits. He manages most of his investments as a partner at Flight Ventures and IDG Ventures, as well as leading multiple syndicates on AngelList. Funding is an essential part of building new companies for a lot of people. And as an entrepreneur himself, Gil has broken some normal rules in VC funding and term sheet negotiations with what he calls object-oriented capital. So I wanted to discuss this topic with him. Hi, Gil. How are you?
Great to be here. Thanks for having me.
I saw your article in TechCrunch last week about the challenges of Series A funding and the concept of object-oriented capital. It was very interesting. Wanted to just ask you more. Now, as far as stages of funding, things have definitely changed also in the last 3-4 years. What are the current stages of funding for brand new startups?
Yeah, it's funny. What you normally call seed has changed dramatically. I would say there are 3 stages of funding now before Series A. There is what's being now referred to as pre-seed, or I would say in many ways pre-launch, which is often friends and family, and there's a handful of pre-seed investors like Precursor. And then, the next stage of funding is often incubators, right, who are writing small checks or
accelerators, as they call them these days. Okay.
Yeah, incubator, accelerator. Sometimes I can't tell the difference, and I talk to entrepreneurs who have gone through 1, 2, and even 3 incubator accelerators before going out and raising a seed round. And I think a large part of that is that seed has gotten bigger, right? You're seeing $500,000 to $2, $3, $4 million seed rounds. And so the amount of proof you need even to raise a seed now has gone up.
So seed is really the old Series A, right?
It really is. It really is. And it's just a lot cheaper than it used to be because of AWS and
right.
apps, and not really needing as much money to start a company as you used to.
Okay, so now after that round, then the next step is the quote-unquote Series A, which is really the next level. And for that, what is required from the companies?
In consumer, $10 million, 10 million users is the new 1 million users, right? It's increasingly with, the App Store and SEO and Facebook, it's easy to find, tens of thousands and even hundreds of thousands of users. And so you see a lot of things now that have 1 million users and no one cares. It's much more revenue driven. Series A used to get done at $1 million a year in annualized revenue, or about $80,000 a month. And increasingly that number has gone up to $150,000, $200,000 a month before Series A is getting done. I'm looking at an interesting company called Door right now, DOR, and they let a small business put a scanner at the door for $50 and see how much traffic they're getting every day and why and at what times, and sort of measure traffic patterns on the cheap. And then they have a SaaS revenue stream alongside the product. So, do you measure it on product sales or on SaaS revenue?
That's like a combination model, right? Where they sell products and they also have a monthly service. There is really no hard rule. If you can make both of them work, then more power to you, right?
Yeah, but ultimately, the razor and the blade analogy holds, right? You're either subsidizing the razor in order to sell blades, or you have to make money off the razor because the blade sales are very small, right? You don't typically find a company that makes half their money on one and half on the other.
So one helps the other.
One is dominant and the other is often sold at cost or even below cost, right? Like the Xbox, they lose money on.
They make money off the games.
Yeah, that's the razor and blade.
Okay. So what is your concept of the object-oriented capital? This is definitely a geeky name, of course.
Thank you.
You're right. So, but it resonates well with the audience. So what is this, and why were you thinking that it's needed?
So, even in sort of these bigger seed rounds and in Series A, if you haven't done 10 deals or 100 deals. If you haven't been a serial founder, you get presented with all of these terms, these objects in a financing, and everyone keeps telling you their stand. Emotionally, as an entrepreneur, I hate it when somebody tells me there's a rule, because I immediately want to go figure out a way to break it, right? But
Yep.
you keep hearing, well, this is a rule. We do it this way. It's always been done this way. And the more I would push on it, the more I would find out everyone has a different rule. There is no common rule. And these are just excuses people make to avoid negotiating with you. And so, from my perspective, these things have value, right? Preferred has value, pro rata rights has value. All the things that VCs put into their documents create value for them. And you should really think of it much like object-oriented programming. You should say, okay, each of these things has an economic building block like Lego, and let's take the various Lego blocks and construct the one that works for us. And so, if you don't like this, you'll have to pay more somewhere else. So rather than being inflexible and just sort of rule-based, why not lay out a set of Lego blocks and let entrepreneurs assemble the best Lego castle for them?
Is there still what's used to be called a Series A crunch?
There's always a crunch at some phase. How's that? Is one way to think of it, right? Sometimes Series A, there's less money than you'd like. Other times, the late stage is gotten sort of depressed and there isn't enough late stage money. So I don't really think that there's a Series A crunch per se right now. Let me try to answer that a different way. The cost of starting a company has gone effectively to zero. So it is very easy to raise $10,000, $50,000 or bootstrap something to some level of significance. And the problem then is there's too many small coffee shops that all want to raise money and become Starbucks. So you could say that's a crunch, or you could say that in reality, we just have a lot more companies able to raise a small seed and get some traction that no one cares about.
So what does that tell about the early stage? Is the criteria easing up as far as like giving people the 50 or 100 or 200K?
Yeah, I do think seed has gotten a lot easier, and a lot of the documents, like the convertible notes, have made it much more efficient. But what that means, if you're an investor, is the seed stage infant mortality has become much higher, right? It used to be 1 in 3 seed stage companies raise an A. I would argue today, if 1 in 10 raises an A, I'd be shocked. And so that's where people perceive a crunch, right? As they say, well, there isn't enough Series A going around. And I go, no, there aren't enough good companies.
So the other side of the equation has changed instead of the money side of it.
Yeah, there's a massive explosion of new businesses. Or as, Bezos said back in 95, pre-Cambrian, evolution, lots and lots of organisms appeared and only some of them survived.
And of course, leverage in negotiation is an art and a skill, and also can be based on facts, right?
The hotter the deal, the more the company has leverage. I mean, I remember a friend of mine looking at the Dropbox round, and the Dropbox team sent the VCs a term sheet pre-filled out with all the information except how much the VC was investing. They're like, here are our terms. We will be collecting checks. Please let us know if you want to write one.
Well, yeah, take that as a standard, right?
That's awesome. We should all do that. That's fantastic.
It's not just confidence, blind confidence. They knew what they're doing, and they knew that the value of their product was there. I love hearing examples of that, and that's really what your point is from this article, right?
I think regardless of what you're doing, there's a lot of value in trying to set some standard terms and focus on sort of making everyone comply with a set of terms that work for you. And then most of the decision is, well, what price are they willing to do this deal at given those terms?
Where does the role of the lead investor come into this? Like, if you're not somebody that's had 10 successful or whatever successful exits, and you're just pretty much getting started, you have some traction, but you don't have experience, a lot of experience, would the lead investor actually help?
Well, I mean, in reality, the lead investor is trying to screw you because they're trying to get the best terms they can.
Right.
So typically, if you spend a bunch of time in Silicon Valley, what you hear is you need to get some smart angel investors in before you go out and try to raise money from venture, because these angel investors have seen this game a bunch of times. They know who are the VCs who are particularly focused on screwing you versus the ones that are more collaborative, and they know what reasonable terms are. And so you want, 1 or 2 of these people who are already investors, so their incentive is not to to screw you. Their incentive is to protect their investment by giving you good advice.
Do you accept that explanation?
Yeah, and I think there are other ways to get it. I mean, you can start an advisory board and bring in some smart people. You can try to raise seed money early, and I mean, another strategy is to raise as little money as you can. It's ultimately about aligning incentives. You want some smart people on your side whose incentive is to help you get the best deal you can. And sometimes the best deal is, look, there's one VC who really knows this stuff better than everyone else. Who cares about the price? Who cares about the terms? Like, if I can get this guy on my board, I'm happy. And that, so this is not all about like how to get the best price. It's ultimately a puzzle that you're trying to solve rather than, just a single thing you're optimizing for, right? There's price, there's terms, there's who your investor is, there's, expertise, there's reputation. And so to me, the value in object-oriented sort of investing is the notion that people can assemble what's best for them rather than having an inflexible box.
Of course, not all investors are the same. Some of them genuinely want to help and they're not trying to screw you, but there's definitely a number that are, and that's like the part of the due diligence of the entrepreneur, right? The founders, to find the right people.
Yeah, and people screw you in different ways when you're an entrepreneur too, right? I mean, there's the VC who is very focused on having too much control, and there's another VC who doesn't care about control but wants a really cheap price. And, it's not that they're bad people; it's just that they have their own incentives,
right?
And their incentives are rarely aligned with yours. The classic complaint I always hear is, those guys at Sequoia prevented me from selling and I could have made millions of dollars, but they said go big. And then, of course, when we failed, they didn't care.
That's where the right of first refusal term comes in, right?
Yeah, that and veto rights.
Or veto rights.
So like Sequoia might say, as an example, they might say, we're not going to allow this acquisition to happen. So just stop talking about it. As I mentioned, in the TechCrunch article, like I actually had an entrepreneur who said, I've heard a bunch of horrible stories about entrepreneurs not being able to sell when they wanted to. And I'm really not okay with you having a control over that. And I said, okay, that's fine. I don't need to have control over that. But if I don't have control over that, there's some scenarios where you might sell and you make money and I don't. So I just need to think about that incremental risk I'm, taking, and that'll factor into the equation somewhere else.
Right. I mean, it has to be. It's definitely a two-way street. You hear, I'm sure in the investor circles, you hear a lot of horror stories about entrepreneurs and vice versa. So I think that's the key is when you get to that point that you have balance. Now, talking about actually looking at different companies for investment. Are you even looking at any companies these days that are not coming out of an accelerator?
Sure. I mean, there's all types, right? There are, serial entrepreneurs who can go out and raise a big round because they're who they are and they've done something awesome and they want to go do a second awesome thing, right? And there are a ton of companies that have been bootstrapped with the founders $10,000 and now they're raising money because the thing is just, the server bill's gotten too expensive. And there are things coming out of incubators, and there are, executives from companies who are leaving to go start something and are well known. So, there's, and that's sort of where this notion of the Series A crunch sort of exists, is the incubators are churning out over 1,000 companies a year. Plus there's entrepreneurs starting companies. Plus there's serial entrepreneurs getting back in the game. And so there's just an enormous number of companies being started that are all thinking that they should raise venture capital. My advice to entrepreneurs is often, when you're raising based on the story, raise as much as you can, because it never gets easier. Because when you're telling me a story, I'm like, oh my God, can you imagine a world where, right? Pizza drives itself and it doesn't need a car.
Or pizza eats
itself. That would be
itself.
amazing.
Right, yeah.
Right? And then you get traction. You're like, oh, there's only 7 pizzas driving a day. Like, wow, who cares?
Okay, that's a good example. I'm sure somebody's going to come up with that. So,
well, I think my favorite one recently was the cannabis drone that delivers weed to you, real time.
Wow.
And I was like, oh God. A bunch of stone drones flying around. Fantastic.
Tell me about IDG. How is that firm different than other firms?
So I've been working with the IDG guys for probably about 5 years, and it's sort of a classic Series A firm. We do a lot of sort of bridge and A rounds, $2 million, $5 million, $10 million rounds. And, as I mentioned in the article, I found them to be very flexible, and I am pretty creative. So I kept coming to them with like, hey, can we do this? Can we do that? Unlike a lot of big firms that seem to sort of have a very clear box they wanted to stay in, these guys are nimble and flexible and creative. And so when they asked me to sort of get more involved, I said, sure. It seemed easy, it was sort of an easy conversation.
You still are doing the AngelList syndicates as well?
Yeah, we have about 40 different AngelList syndicates now that we run for other entrepreneurs, as well as the one I run. And so we sort of help. What I love about AngelList is it's entrepreneurs who are syndicate leads, funneling money from entrepreneurs who are the angels into entrepreneurs who are starting companies, right? And so entrepreneurs helping entrepreneurs instead of a bunch of bankers screwing entrepreneurs.
The lines definitely are fading out between who's an investor these days. I mean, everybody's an investor, right?
Yeah, I guess, right? One of the nice things with AngelList, it's sort of like, if you remember when Schwab or E-Trade first came out in the 90s, you're like, wow, anyone can invest in the stock market. It used to be $300 or $500 to do a trade at a big broker company. And so when you make it accessible, more people do it. And AngelList has sort of brought the bar down. When I first started angel investing, I remember meeting with entrepreneurs and they're like, we're raising $25,000 minimum. And I would say, well, I've got 5,000. And they would say, it's not even worth the paperwork to take your 5,000. I was like, okay, how about I give you 10,000? We would literally negotiate on how little I could put in. And with AngelList, the increment now is $1,000, and I keep telling them the increment should be $50.
One thing that I've noticed is that, I see leads only putting in $1,000 on a deal. And that to me is like almost like a signal. If you really believe in this deal, are you just putting in $1,000?
Yeah, it depends, right? Like I have a friend who is a syndicate lead, and he puts in $1,000 a deal. And I can tell you, for him, $1,000 is a lot of money, especially if he's going to do 3, 4, 5 deals a year. Like that matters to him. I can tell you, if I'm putting in 1,000 or 10,000, it still doesn't matter to me. Right? So the signal is relative to the net worth or income of the person, which you don't know. So it's really often hard to gauge skin in the game. The other way I would look at it is when a VC raises money, they're guaranteeing themselves a $500,000 to $1 million salary, plus some profits if they make you money. Whereas on AngelList, everyone who's a syndicate lead is saying, I will lose money unless this works. From that standpoint, the alignment of incentives is better. And, and I've had those conversations with my 5,000 backers on AngelList. And they're like, hey, Gil, why should we trust you? I say, well, I only make money if you make money. So if the deal looks stupid, there's literally no reason I will do it, right? Why would I guarantee myself a loss for no reason, right? I don't get any management fees. There's no income. And, the company has to make a profit for me to make a dime. So
okay.
That alignment is good. What I would say, to be fair, is if I put $1,000 in and I raise $1 million, it's some pretty nice leverage for me. So it might encourage syndicate leads to take riskier deals that are higher beta than maybe a VC would. But to some degree, my argument is that's a good thing because high beta is actually what you're aiming for in this business. You're trying to find very risky deals that when they work, are 10x or 100x or like my LinkedIn investment was a 700x. It's crazy.
Yeah.
The original Facebook investors were, thousands of X.
Talking a little bit about different verticals. I know that your syndicates sort of like focus on different verticals, right? Like AI or security. Are you doing anything as far as like commerce related deals?
Yeah, we've done a lot of e-commerce. We did Dollar Shave Club, which got acquired for about $1 billion by Unilever, and then did Madison Reed, which is a women's subscription for hair coloring. We're in Stance, which is a furniture company. And what I would say is, in the era of Amazon is literally destroying all retail, I would not have invested in Jet or any other company that is trying to be an e-commerce retailer but I'm investing in brands that want to use the internet as part of their distribution channel. So Stance socks is a great example, right? They sell online, but they also sell through retail and many other channels. And those are interesting because they're actually building the product, right? Casper and mattresses, that sort of thing. Dollar Shave Club was single channel, right? Where Stance is multi-channel. So
right.
I'm less obsessed with single versus multi-channel. I'm more like, are you building an asset that has long-term value that Amazon can't, easily replicate?
Speaking of that, technology is easier to replicate now than the brand, right?
Yep.
As you said, you're really more focused on the brand.
In e-commerce, yeah.
The example you gave me, DOR.
Yep.
So that's the other type, that's the other side of retail. These are technologies enabling retailers to operate more efficiently or do better. So that's
better insights.
Right. So it seems like you're also working with those kind of companies, not just necessarily just brands.
Well, that is just a SaaS business that happens to have this unfortunate need to sell some hardware. Much like Square is a payments company that unfortunately sells some hardware.
The term "unfortunately" is interesting for me. So you think that is a negative point about the company?
Yeah, from an investor perspective, it means more capital, inventory risk, another risk factor. It's not just, is the software going to work? You also have to say, like, can we build good hardware? Is our hardware going to have warranty problems and returns? Open Table, in many ways, was sort of the first of these, right? They literally sold you a cash register, and it took 10 or 15 years to become an awesome company. Because today, you would never start Open Table with a cash register, right? You'd say, hey, go buy a $40 Amazon Fire and download the software. And so these vertically integrated companies work early in the hardware life cycle, right? Tesla works because by owning the car and owning the data and owning the software, they can sort of build this package. But 20 years from now, you won't need a Tesla because, cloud-based driving will be, easy, and everyone just assembles a shitty car made in China.
The other side of this equation is that the more touch points maybe you have with the customer, you may actually have a better connection with them. Like, if you have a phone that has software on it, it's a lot harder for you to replace the phone than just get a new app that has no hardware connection to it.
Yeah, I mean, like switching from Android to iPhone sounds like a massive headache now that I have 50 apps. If I only had one app, it's a lot easier.
Right. Or, for example, a thermostat Nest that is actually installed in your home. That's harder to replace than if you just had a
thermostat app.
Right, and you just had an app. So I think on the one end, I definitely see that it is an extra risk factor, but it may, if it's done right, it may actually help you have a longer LTV or a higher LTV.
Well, I do. I'm just not sure that in the early days when your capital is the most expensive, it's the worst time to do it.
Yeah, I agree.
Right. I mean, and you see the entrepreneurs who are already saying, like, yes, we're building it now, but pretty soon there'll be 3 guys in China copying it, and we'll just sell the software. Right. I mean, Amazon is, building Alexa, right? And I bought one, and it's awesome. But pretty soon, Alexa is going to be built into the next generation of Chinese TVs, and it'll be built into Bluetooth speakers. And then I won't buy an Alexa because it will just be built into everything. I'd much rather have that business than the fully integrated speaker with smart listening.
If people want to get in touch with you, how do you want them to get in touch with you?
Yeah, people can reach out to me on Facebook or LinkedIn. Gil Penchina.
Okay.
It's a pretty unusual name. And they can back me on AngelList if they want to see the sorts of deals we're doing.
Well, thank you so much, Gil, and we'll talk to you later.
Take care.
Take care.